Ever experienced how frustrating bank problems can get? Well, for many Americans, it's become unavoidable since a recent bank outage has left many people locked out of their own money. What are the details of this issue and what's the way forward? Let's find out. Forget cryptocurrency and other digital financial setups. For the average American citizen, banks are the safest way to keep your money. But what if we told you that banks you relied on to protect your hard-earned money are actually hanging by a thread? Yes, it's true. Right now across the US, dozens of major banks are teetering on the edge and your savings might be at risk. This became increasingly evident in October 2024 when the US got a surprising wake-up call about how fragile its banking system really is. On the afternoon of October 2nd, a huge outage hit Bank of America, leaving thousands of customers across the country unable to access their accounts. For those who could log in, the nightmare wasn't over. Many found their account balances showing $0. Naturally, panic spread quickly as people feared something far worse might be going on than just a technical glitch. This incident, combined with the fall of fintech companies like Synapse, really highlights a major problem. The banking system in America might not be as secure as we all thought. Banks have always been seen as the ultimate safe place for money, but recent events show just how delicate things really are behind the scenes. The Bank of America outage was just one example, disrupting their online services and leaving many customers stuck, unable to check their balances or access funds. You've probably heard about multiple banks going under, another bailout on the horizon, and whispers of a new financial crisis. Let's face it, with everything going on, skyrocketing inflation, crazy interest rates, and talk of a recession, it's hard not to wonder if your money is really safe in the banks. And you'd be right to be worried. Banks operate on a delicate balance. They take in your deposits and loan that money out. We hope it all works out so they can handle withdrawal requests when you need your cash. But what happens when that balance shifts and things go south? In 2024, we've reached a tipping point where the banking system's fragile balance is starting to crumble. Inflation is causing chaos for families and businesses, making it harder for many to pay off their loans. When people stop making their payments, banks go into full-blown panic mode. And it doesn't stop there. Rising living costs are draining people's savings. More and more are tapping into their emergency funds just to make ends meet. Meanwhile, behind the scenes, banks are drowning in debt and dangerously low reserves. Sound familiar? That's because it's starting to look a lot like the warning signs that led to the 2008 financial crisis. Experts at Stanford are pointing out that many US banks are now vulnerable to mass withdrawals and bad loans, two major factors that helped bring down Credit Suisse in 2023. And to make things worse, the Federal Reserve's policies have only weakened the banking foundation, creating even more instability. If uninsured depositors start taking out their cash, a lot of banks might not survive the storm. High interest rates are also making the situation worse, pushing credit standards to the max and reducing demand for loans from both consumers and businesses. This means banks are having a hard time making profits. In addition, the shift to remote work has caused a huge drop in demand for office space, which means banks are now taking on risky commercial real estate loans. The defaults on these loans are putting major financial institutions like New York Community Bank at serious risk. Now, the big worry is that the US economy slows down so much that bad debts pile up, banks start losing trust in each other, and we're faced with a full-blown 2008-style liquidity crisis. If that happens, weaker banks could go under and your money might go with them. So what are the banks doing to try and stay afloat in all this chaos? Well, they're making some pretty drastic moves. For one, some are closing accounts they consider risky and shutting down branches left and right to prevent a run on their cash. Yes, it's happening. Banks are taking extreme steps to protect themselves. Some of the movers and shakers of the finance industry, like Bank of America, US Bank, Wells Fargo, and Chase, are leading the charge when it comes to closing branches, with hundreds of locations shutting down. In fact, over 700 bank branches across the US were shut down in the first 9 months of 2024 alone, leaving communities in the lurch. At this rate, more than 1,000 branches could close by the end of the year. Many banks are also pushing customers toward online services. Why? Well, it helps them save money by cutting out the expensive cost of maintaining physical branches and reducing the risk of local bank runs. And that sounds like a smart move, right? Well, not so much if you're in a financial crunch and suddenly can't access your money due to an internet outage or a system glitch. And that's not all. You see, there's also the fact that for a lot of Americans, having a physical branch to walk into still feels safer. According to a poll by Self Financial, around 39% of people trust banks with actual brick-and-mortar locations more than digital-only ones. But as the world leans more into virtual banking, customers are finding themselves with less control over their own money. But here's the twist: even online banks aren't safe. A fintech company, Synapse, collapsed recently and left thousands of Americans staring at empty savings accounts. Synapse, which powered the banking software for trendy online banks like Juno and Yotta, basically vanished, taking people's cash with it. Court documents show that about 10 million accounts were affected, but regulators aren't offering much help, shrugging it off as a lost cause. It turns out these so-called online banks weren't really banks at all. They promised fun perks like high interest rates and FDIC insurance, but behind the scenes, they funneled money through middlemen like Synapse, who worked with traditional low-key banks. When Synapse went under, it had only $2 million in cash but owed way more, leaving customers unable to access their funds. And here's where it gets even worse. Even though actual banks didn't collapse in the fintech mess, that doesn't mean FDIC insurance is coming to the rescue for everyone caught up in the chaos. It's all kinds of messed up, and it's seriously shaking people's faith in the entire banking system. Right now, 3,800 US banks are teetering on the edge of failure, with total unrealized losses hitting a jaw-dropping $478 billion. To keep things from going haywire, regulators like the FDIC are keeping the names of the most vulnerable banks a secret, but the Federal Reserve's annual stress tests are showing that about 300 banks could actually crumble if they face any real financial pressure. And about that Synapse disaster, well, it wasn't just a minor setback, it was a full-blown catastrophe. Before they went bankrupt, they lost tons of fintech clients, shut down crucial systems, and somehow managed to misplace $96 million of customer money. No one has a clue where that cash went because, get this, Synapse can't even scrape together the cash to hire someone to track it down. The aftermath, it's regular people, FedEx drivers, teachers, dentists, small business owners who are left picking up the pieces. The situation is looking very bleak. Court records show that a staggering 10 million accounts were wiped out in the mess. And take Yotta, for instance. 13,725 customers lost a total of nearly $65 million of their hard-earned savings. And what are they getting back? Just 18 cents on the dollar. For every $100 they deposited, they're getting back just $18. And here's the kicker: unlike risky crypto or meme stock gamblers, these customers weren't taking big risks. They thought their money was safe in FDIC-backed accounts. These were hardworking Americans who lived regular lives. So where did all the missing funds go? Well, they've disappeared into what can only be described as a financial Bermuda Triangle. Synapse's bankruptcy revealed major holes in tracking who owned what, and Evolve admitted it had transferred large sums of money without properly identifying account holders. Now, it's almost impossible to figure out who lost what. In the meantime, victims are getting nothing but vague excuses instead of real answers. And don't think the big banks are safe either. If the economy takes a dive, the top 30 US banks could collectively lose a whopping $685 billion in 2024, a $144 billion jump from last year's projections. Why? Well, higher interest rates have made lending more expensive and riskier, slashing profits. Add to that the massive exposure to commercial real estate and unrealized securities losses, and you've got a recipe for financial disaster. Experts are sounding the alarm that many banks are teetering on the brink of a liquidity crisis, especially those with a high percentage of uninsured deposits. Banks like Bank of New York Mellon, State Street, and Northern Trust are at the top of the list, with uninsured deposit rates as high as 100%. If those depositors lose confidence and start pulling their money out, these banks could face a catastrophic run. Overall, the entire banking system has been shaky for a while now, and waiting around for regulators or the Federal Reserve to swoop in probably isn't your best bet. So how do you protect your money before things get worse? Well, first off, don't keep all your money in one spot. Think of it like this: putting everything into one bank is asking for trouble. Spread your savings around between multiple banks or even credit unions, which often have a reputation for being more stable. Next, it's always a good idea to have some emergency cash on hand. Banks can freeze withdrawals during a crisis and you don't want to be caught without access to your money. Keep a small stash of cash in a safe place. It might not earn you any interest, but it could save you when times get tough. And finally, stop relying solely on banks for your financial security. Look into diversifying with stable investments like gold, real estate, or inflation-protected bonds. These options often hold their value better during economic downturns and can give you a much-needed safety net when the financial world gets rocky. Taking these steps now is the smart way to stay ahead of any banking crisis. The warning signs are there. It's no longer a question of if another bank will crumble, but when. Taking action now can save you from a lot of financial heartache later. These recent banking fiascos have laid bare the tough truth. The US banking system isn't as safe as we'd like to think. Sure, the government has swooped in to save big banks before, but when it comes to smaller players and everyday folks, you're pretty much on your own. The Synapse collapse is a glaring reminder that trusting blindly in the system isn't an option anymore. It's a wake-up call for everyone, customers, banks, and regulators, to demand more transparency, accountability, and stronger protections. The cracks are already showing, and unless serious changes happen, trust in the banking system will keep eroding. That's all for this video on major bank outage that left Americans without access to their money. What do you think about the bank outage? Have you been affected in any way? Let us know in the comments section and enjoy our other videos.